We will now, inevitably, we will have to come to the concept of break-even point. But before we come to this concept, we have to talk again about the costs from a different perspective. Again, from a different perspective. So we have to now make a short signal that there are some expressions, namely sunk cost and committed cost. It's very important to know what it is, because in your future job, you surely, sooner or later, you will come to the point of sunk and committed costs. So what is sunk cost? It's one of my favorite expressions. It's sunk cost. Sunk cost, as the word shows, it's like you throw something into the water and this thing is sinking and then it's sunk. Sunk cost means that it's gone. No matter what will happen, it's gone. Yes, it's something that is not retrievable and it has no influence on what we will do now. It's just gone. We just spend this money. It's sunk in this project. That's it. And then we will have to free our mind and forget that we already sort of thrown in the mud like $1 million or $2 million and still the project is not done. It's sunk. And you have to admit it. It's sunk. Another concept is committed cost. It is a cost incurred in the past, but still not paid, but there is an obligation will be paid. So like you promise somebody that you will pay. Still, the money has not gone, but it's an obligation, very often a legal obligation, that you will transfer this money. So this is the definition of the committed cost. Yeah, you just signed something, you probably own already the thing, but still the money is not gone to the seller. So these two are very important, sunk and committed. But now we have to approach one thing very important to understand while we are talking about the costs of production, costs of manufacturing, costs of producing something, cost of delivery of the service. And these are fixed and variable costs. Probably many of you heard about fixed and variable costs, but in this part of the lecture we will have a close look on this. So we incur costs in the business, we run the business, and we have to classify these costs, according to their behavior. I mean, they behave in a certain manner in line with the amount of production or amount of service. Or we could call it volume of activity. So fixed costs, as a pure definition, they remain the same regardless of sales. No matter how much we produce, it doesn't matter how many pieces we have on sale, these costs are the same. We produce 0, they are the same. We produce 1,000, they are the same. We will come in next couple of slides which ones are these that we could call fixed costs. Then we have something different, and they are variable costs. Variable costs means the costs that change, and they are closely, in pure definition, they are closely related to the volume of activity. So let's say we produce 10, so the cost will be 20. But when we produce 100, then this cost will be 200. Something like this in sort of simplified way. That these costs, these variable costs, are always related with the scale of production. Now, we have to understand it properly, because you, as future managers, you have to know which ones are which ones and know some nuances. You will see there's quite a number of them. So, what is this fixed cost on the graph? This fixed cost on the graph looks like that. That in ALX we have the volume of activity measured in units of output, and on the vertical line we have the cost, and this is in pounds. So this fixed cost of a something will be the same no matter how many things we'll produce. So if you are to do a graph like this with the volume and the cost, the fixed will be like this. And then what you might think, just generally, now we're just talking, fixed costs are independent of output. So they might be considered as a sort of sunk cost for the relevant range, because you have them already. But it's a different concept, like sunk or fixed. And these fixed costs, what they are? You have like building, that you depreciate. You rent a space for your office, so you pay every month a certain amount of money. It's paid. It's paid no matter. I mean, you do some production or not. It's closed for the coronavirus. Doesn't matter. You pay the rent. It's fixed. It's there. Or you have the machinery that you bought and you depreciate this machinery, or something like this. So these are fixed costs. And then we have this variable cost. And if we produce a graph with variable cost, total like variable cost, not per unit, but total, we have like the volume of activity on ILX, and on Y we have cost. And of course, like it's written here, at zero activity we have zero cost, because we just produce nothing, so it's not related with the item. But when we produce more and more and more items, this variable cost will rise, just as we rise in our production of certain good or supplying a certain service. And then, as I said, they are costs that vary, they change. Normally they rise with output. And generally they increase in a sort of constant rate. Of course, when you do a very specific analysis, you might find there is some kind of variation. There will be a table, I will point it to you later, about bakers. But generally, it's in a constant rate relative to labor or capital. It's just, generally it's with labor. I mean, more people are working, the more they produce. Generally, it's like that. So, what are these variable costs? They are wages for employees or salaries. They are utilities. They are materials used in production. There is a sort of a nuance here, I would just point it, that sometimes people say about salaries that are like fixed for a month, and say about wages as a remuneration for your work like per hour. Like people are employed per hour, then we talk about wages. It's just for hour of work spent. So, and materials are just evident example of variable cost, because when you produce anything, there is, of course, raw material that you have to put into this product. And if you produce five items, you use say 5 kilograms. But if you produce 10 items, you would use 10 kilograms. So this will be the variable cost of your business. Then we have something, we will return to it later, something like fixed costs are not always fixed. This is a very tricky thing because, as a definition, fixed are fixed. So what is it all about? How fixed is not fixed, you might say. So this is a sort of an explanation with the nice graph from Sari, that as the volume of activity increases from zero, yes, for example, rent, we have rent cost, is unaffected because we do more and more. But it might happen that in a certain point of the development of your business, and you need more and more people and more equipment, actually you do not have enough space to put people. So you will have to rent additional space somewhere. Maybe you rent one floor of the building, and then you just expand with your business and you just need to put another floor. Or, for example, you are doing the business in Tallinn, but then you think, okay, I will do it as well in Beijing. So you have to rent additional space in Beijing. So it means that at a certain point, suddenly, you have second location, so your rent cost goes double, and then it remains fixed for additional amount of time. Yeah, so you just expand. And then on the example, probably you might rent another floor, third floor, or a location in, say, Shanghai. So this is the concept that fixed are not always fixed. We will come to this. I mean, they are generally fixed for a certain period of time or certain scale of activity. As I said, it's related with time, because what it says here, we have this brief introduction to the concept of time. Because for many firms, the division of total cost between fixed and variable cost depends on the time horizon. Because what might happen is that, this year you have one office, and next year you will have 2 offices. So in the short run, these costs are fixed, like rent. But in the long run, several years, these fixed costs may acquire certain features of variable cost, they jump with the scale of production. But it's not stable. It will be always a jump, a step. Therefore, sometimes it's called step fixed or semi-fixed cost, when in long term, by the way, in the long term, inevitably these fixed costs will be different in different years, in different seasons, in different moments, because as we think you expand the production, you will have to expand with this fixed base of your business. So therefore it's that. And another issue are mixed costs. It's another name for another concept. This name is for certain costs that partially they might be fixed and partially they might be variable. And it depends on a particular case, on a particular business, and a particular usage, that they may be treated as fixed or they might be treated as variable. Yeah, you might be a bit confused. What's all about? I mean, how something could be either fixed or variable? Okay, let's have an explanation. We have like big letters here, because these mixed costs, they could be semi-variable or semi-fixed. People call it, as we know in economics and finance, certain people call certain things in certain way, and it's not always constant. So sometimes it's hard to distinguish, is this cost fixed or it's variable? And we have a very simple example. There is a small hairdresser shop, and there is a lady who is in charge of making nice haircuts to the female clientele, and she does this job. And of course, she uses electricity. Yes, but then this electricity, we as economists and finance people, we see in different way. Because when we say about electricity that it's used to lighten the room, or electricity that it's used in the night to light the window with the name, something like this, or electricity needed for, I don't know, like constant air conditioning, for example, then it will be fixed, because it goes all the time. There are no clients or 100 clients, it doesn't matter, because it's fixed. As a basis for running the business, there must be some light. I mean, we assume that, of course, it's not really winter and summer, that it's all the same amount for electricity for lighting. But then, if the electricity is used for hairdryer, and sometimes it's used a lot, as far as I remember the haircuts, female haircuts, sometimes there is a necessity to sit under the specific hair dryer for an hour or something like this. So this is directly related to the number of customers, because it's used to dry the customer head. So more customers would come, more electricity will be spent. So in this point of view, electricity is considered as the variable cost. Now, so maybe we will make a short summary. I'm looking for time. Yeah, short summary. So what we have as the examples of fixed costs. Yeah, we have to remember that they remain constant for a specific period of time, usually. And this is related with a scale of activity, that it's within certain range. And it's like rent, I mentioned this, insurance as well, for example. You have to insure your business no matter what you do. Cleaning costs, if there is a cleaning every day, it's every day cleaned. Staff salaries, I mean, you employ people on a monthly basis, so they do anything or they do not do, you have to pay them. You have the depreciation of factory buildings. As well, for example, you have people in the factory, for example, supervisors. And there's as well like salary which is fixed. They supervise no matter what happens in the production. Or salesmen and their cars. They're on lease. So no matter how much you sell, it's fixed cost. And as well, just let me remind you, these costs do not depend on the volume of production, and it means that they are fixed in a certain period, short to medium, and they are based on time. Then we have the graph of the total fixed costs, and because it seems I have almost run out of time. So we will stop at this point. Just could you imagine to draw the graph? How would you draw the graph of this? When you have like activity level in units and total fixed costs. How would you do it? How would you draw it? And then you have another one which is activity level and a fixed cost per unit. Costs are sort of concept that many people think from and see from different angles, and they define it differently. So when there is an expression with costs, say fixed costs or variable costs, for example, you must really attach this expression to a certain theory and practice in financial management. Therefore, we will start with this definition about costs, fixed and variable. I have mentioned that before, and I think that we have described it somehow, but we will continue with the description because it's very important to have a fundamental knowledge how we distinguish and how we describe the costs. So the concept of fixed costs is very important because no matter what you do in your company, you will still have to pay fixed costs, even if you do nothing, even if you do not produce anything, and even if you do not sell anything. So therefore, it's such an important thing in the business to cover fixed costs. And then you have to know what these fixed costs are. Generally, they are closely related to time because they are fixed in certain period of time, usually very long, more than a year, and sometimes 5 years, sometimes even more, but it's a long run. And some of them, unfortunately, these costs may be conceived as fixed or variable, what makes them mixed costs. Because depending on the particular usage in your business, you will treat them either as fixed costs or as variable costs. We will talk about that in a moment. And these costs, they have different names. Sometimes they're called mixed, sometimes they're called semi-variable, sometimes they're called semi-fixed. Here, there will be an example on this slide. There is a classic example of a very small hairdressing business. And there is a hairdresser, and of course, there is an electricity bill to be paid at the end of the month. Generally, this is how it works in majority of countries. So, inevitably, hairdresser would use electricity. Full stop. But then, the really key matter is what for this electricity is used. Because if you assume this shop with a neon and lighting on the ceiling, that it's all the time there, it's fixed because nobody would sit in the dark. Or if you want to make your business that you are there, then you need electricity. But if it's used for drying customers' hair, it's variable. So we have a sort of summary of fixed costs now, and they are like it was meant previously, like rent, insurance, cleaning costs. I mean, these ones that are regular, staff salaries. I mean, no matter if they have clients or not, you have to pay them salaries and their insurance and their old age pension, everything. Then if you have a building, there is a depreciation. If you do anything or not, it's still depreciation. Then if you have a production and there are supervisors, whatever is produced, they are there. Or you have your salesman with cars, right? So they do not depend on the volume of output because they are fixed in a certain period of time. Therefore, we say they are time-based. And we had these graphs. I asked you to draw a graph when we would have on X aisle the activity level in units of production, in heads of customers, in sold excursions to a nice country, in room bookings, unit. Whatever unit in your business you have, then this unit is on aisle X. And then on Y, we will have these fixed costs. And on one graph, we will have total fixed costs. And on another graph, we will have fixed costs per unit. So how it does look like? It looked like this. We made an approach during the seminar. Look, this is fairly simple to distinguish because if we concentrate on the graph A, we will see total fixed costs. And whatever the production is, I mean, in a certain period of time, and certain scale, we will talk about it a bit later. But in normal, like one place, certain amount of time, whatever the production will be there, no matter what the production will be, the total fixed cost will be the same. Therefore, the graph is a flat line at a certain point where these fixed costs are. However, when we have this fixed cost per unit of production, maybe this line is sort of bent too much up and too much flat. But what is the idea? Let's imagine that you produce one unit, right? So fixed cost per unit will be, and your fixed cost is like 1,000. Okay, so 1,000 divided by one unit will be 1,000. But if you have two units, it will be 1,000 divided by 2 means 500. If it's 3 units, it will be, it's 333 point. But if you have 4 units, this 1,000 will be divided by 4, it's 250. So there is this shape. Inevitably, this shape would be the total fixed costs per unit of production. So natural question is, so what about the variable costs? Variable costs are these costs that are directly related to units of activity of the company. Activity, product, service, they are exactly related to one unit. And for example, the best example is the raw materials used to produce something. If you produce, say, shoes, you need some leather, you need some plastic, you need some woven material. I'm not a specialist, but it's like this. So more you produce, more items you need. Yeah? And it's in the relation. So when we talk about these variable costs, they are in direct proportion to the volume of activity, the number of units produced. So normal thing will be direct materials, I mean the stuff that you put into the product. it will be, of course, a variable cost. And then piecework labor, labor, somebody has to produce this. You need some workers to do this. You need some people to supply the service. So piecework labor means that the labor is directly linked with this production or this service. A classic example is this energy, electricity for operating machines. When you produce something, you need electricity to move the machine. And there is a certain quantity of this production to move the machine. Therefore, it's electricity that is directly linked with the production. So anything that we could assign directly to the unit of production, that in order to make this unit we need so many hours of labor, so much of material, and so on. So anything that is in direct proportion, we would call variable costs. So here's the point where I would ask you in groups normally during the lecture. So maybe you will not look right now on the next page, but what are variable costs at the hairdressing business? We could imagine some. We have a small shop on the corner of the street, and we have the hairdressers there. So what would be the variable costs in this particular business? We could make now a reflection what it could be. Imagine what material, what other things. Yes. These variable costs would be lotions and shampoos, laundry costs of towels used to dry customer heads, hair coloring materials, hairsprays, drying paper. I'm not a specialist again in this business, but it's quite a large number of these variable costs. As well, if we work like overtime, probably additional labor would be included. Or if we have a specific demand for hairdressing at a specific moment of the year, and we employ more occasional hairdressers per hour, the wage would be the variable cost. Similarly, as we talked about fixed costs, we have as well variable costs, and we could put them nicely in a graph, just to imagine this. So, if we imagine a graph with on the X level of activity in units, and on Y we have total variable costs or variable costs per unit. You may now make a thought about this for a short second. And when we returned to the drawing board, we could see it. And it looks like that. A very classic feature of the total variable cost is the fact that it's a straight line beginning at the point zero. Because when we produce zero, there is nothing to be attached, so no variable costs at all. If we produce zero, no variable costs. And if, say, we produce 100 and it's like 10 per piece, so it's 1,000. But if we produce 300, it's 3,000, 500, 5,000. So it's a straight line. Obviously, the angle depends, but it's a straight line. So this is total variable costs in our business. But when we think about unit variable costs, because it's attached to one unit, inevitably is the same, because it's 10. If we produce 100, 200, 500 per unit, it will be always the same. It will be always 10. Therefore, the graph for that is a flat, straight line. Yes. So now you could ask me a very simple question. Come on. So how to put on the graph total costs of the business? Because when we said that they are either variable or fixed, we have these sort of mixed, but then we chop them. Some of them are variable, some of them are fixed. All right? So we chop them. So we have like finally two of them. Fixed costs and variable costs. So how would be the graph of our total costs if we put on X units and on Y we put total costs of our business? How it would look like? Normally we will make some attempts, but of course you have it on the PDF. So what happens is that now we have a look and discover that. I mean, I hope that you made your own attempt to draw it. And it looks like this. No surprises, because when we put this total costs, yes, you remember, we take the left, where is that? The left graph here plus the left graph here. We add them up. So it looks like this. Of course, somebody would say, yeah, we might put variable costs at the beginning, and then to make the sort of a line or a belt with fixed costs. It doesn't matter, because finally it will be the same, because we add fixed costs and variable costs, and then we have total costs. So you could see with the units it's this kind of a shape. It would be very useful to find how the total cost per unit behaves, total, but it's another subject. Right now you need to know how it looks like in case of total costs on the graph. And then just in a moment I will show you some, say, educational example, because what we were talking right now is like a theory. It's some kind of a theory, because we make things sort of simple or simpler than they are in reality. But I have found, as well it is in manuals, in books, an example of a very detailed cost schedule of a company, and then we have this graph of the fixed and variable costs. And it's worth noticed that this fixed cost curve is obviously flat, but the variable cost curve is a curve. It's not a straight line, it's a curve. We will just point this in a second. And why is that? Because this is with like more realistic data that we could have in theory. Like data are really from the real business, so they are the real figures. So we will see it in the moment. It looks like this. So we have the real data, and they are bakers. Bakers, this is a very interesting thing. They bake, say, breads or cakes. Maybe cakes are better in China. So cakes. They bake cakes. And there's this labor hours, yeah, and then we have this fixed costs and variable costs and everything like that. And you might ask, so why all of a sudden this curve of variable cost in reality, it's sort of bending up. At the beginning it's sort of straight, or it is straight, and then after a while it starts to bend. There is some kind of a theory or a study that in case of labor, because it's very important that labor is a cost of unit, that labor, workers, within time, they have lower and lower productivity. And like they work, say, 8 hours during the night, during first 2, 3, 4 hours, they are doing fine. They're sort of slowlier. But then when the night, because bakers work in the night, so when the night comes, you are deeper and deeper in the night, then at the end of the shift, this productivity of a worker is lower. They work slower, they are tired, they are sleepy, and therefore this variable cost suddenly sort of goes per unit, sort of goes up, because they do less pieces. So the labor is more expensive per piece. Maybe it's too advanced. I just wanted to show you that in reality, it does not look like in a proper theory. For our proper theory, it's a straight line. Variable costs go in straight line. Where is that? Here. And then when it's added to fixed cost to make total cost, it's flat, because otherwise we could not make any calculations. Right. So we have another feature that it's very important to mention. It's step fixed costs. They are called like this because, as we said before, fixed costs are fixed. Yes, but in a certain range of activity, or a certain range of your business, they are fixed. But then, when your business grows, they suddenly jump. And it's like a step, because you do your business, let's say you are this hairdresser, and you do your business in one shop. But then you have more and more customers, and you think, okay, I will do the business in a neighboring neighborhood, district. So you open another shop, and suddenly your fixed costs, at least in case of rent, they jump. They are twice as big, despite the fact that you have not started in the other shop, so you still do not have customers. But then all of a sudden, in one moment, bang, you have more fixed costs. Or say you have 3 employees, and you pay them fixed salaries, and all of a sudden you employ the fourth employee. So your fixed cost, bang, will be of additional person. So it's typical when you have like new shop, outlet, branch, workshop, or new personnel, then the fixed costs becoming step fixed costs. That is a question, how we should write them. How we should write them, these step fixed costs, like total step fixed costs. I suppose it's no surprise to you how it will be written, because it's like fixed costs being flat in different scale of production. So inevitably, it looks like that. Yes, it's fixed to a certain moment, then bang, fixed, and so on and so on. So they are like step fixed costs. Yes, I mentioned this in the case of a hairdresser, but as well, this electricity question is very often in production. When you have a manufacturing company and you are doing something, you are producing something using the machinery. So when this electricity cost that would be for the machinery is, of course, variable. But if it's the electricity cost for maintaining the business or air conditioning or lighting, something like this, it will be a fixed one. So really a reminder that in case of these semi-fixed, semi-variables mixed, you must have a judgment based on your professional experience how to divide which one is which one. So the final, remember, what's the fixed costs? They do not vary with the quantity of output produced. Variable costs are those that do vary with the quantity of output. And then we have total fixed costs, total variable costs, and total is the sum of, of both.